Hi, Randy Dummer, CPA, partner with HHM CPAs in Chattanooga, Tennessee. Topic of this discussion is participant loans in an employee benefit plan. So a lot of plans do allow participants to take out loans. It's not required that they be allowed, but many plans do allow it. But understand that there are provisions that need to be followed when doing loans. The IRS has specific rules and guidelines that cap the amount that a participant can take. That cap is going to be the lesser of $50,000 or 50% of their vested account balance at the time they take out the loan. Some plan documents can be more restrictive than that, including limiting the number of loans a participant can have out at any given time. And also take into account, when looking at that 50% of the vested participant account balance, any loans they've had outstanding previously for the past year. So again, make sure that you look at the plan document, understand what is allowed for those loans. Now, you also need to make sure that you follow IRS rules on the repayment schedule. The rules require that the payments be made at least quarterly in an even manner, and that all payments and loans are paid off within 5 years from the time that they're taken out. Normally, this isn't a big deal. Typically, it's done through payroll deduction. We set up an amortization schedule to get everything paid out within those 5 years, no problem. However, you need to watch out for people who take breaks in service, such as for Family Medical Leave Act or military service or other reasons that they take a break in service. If they're not getting paychecks, then we're not withholding those loan payments and they're not making those loan payments. So you need to make sure that those amortization schedules are continually adjusted so that the right amount is going to be withheld from the paycheck so that they can pay off that loan within the 5-year period. Of course, there is an exception to this 5-year period. If the proceeds of the loan are used to acquire a principal residence, then the loan can be taken out for a longer period of time than that. One other thing to talk about in here along with those breaks in service is that if the break of service is sufficient enough that there are no payments made on these participant loans for 6 months, then that is considered to be a deemed distribution to that participant, and then that becomes a taxable distribution of proceeds out of the plan to them at that time. So again, follow your plan document and make sure you stay within IRS rules when administering participant loans in your plan.